Bitcoin is heavily, heavily correlated to retail trading. It's heavily correlated in the short term to growth. If I'm right and growth isn't going to work the way that it is, this is not a value trade. This is just, if the growth names are not dominating the market, then Bitcoin's going to start to be sexy again when it starts to trade higher. Price drives in the narrative, always, as Paul Tudor Jones said. It's something I believe in. The narrative is bad right now because the price is bad. If the price is back up, the narrative will be very good.
As we just heard Jordi Visser say, the story around Bitcoin is bad right now, for one simple reason. The price is bad. It's not a flaw in the technology. It's a reflection of the market. Bitcoin, in the short term, is heavily correlated with high-growth speculative assets. And right now, that entire category is under severe pressure. But this isn't your typical bear market panic. In fact, as Jordi points out, the wider market like the S&P 500 is still near its all-time highs, with blue-chip stocks like Goldman Sachs and JP Morgan performing well. So what's actually going on? The answer lies in a massive, often invisible market rotation that's happening under the surface. It's driven by a powerful confluence of seasonal factors that many retail investors miss. Mutual funds selling for tax purposes, banks de-risking, and hedge funds protecting their year-end bonuses. It's this kind of deep market insight that can give you a real edge. So if you appreciate this level of analysis, make sure you're subscribed to the channel for more breakdowns like this. Understanding this rotation is key to seeing why Bitcoin is struggling now, even as the broader economy seems stable. But while these short-term headwinds are powerful, Jordi argues they're also masking a much more profound, long-term transfer of the asset that is quietly gaining momentum. To get the full picture, we have to start with the mechanics of the current market. Jordi begins by explaining the forces at play that most traders never see.
All right, so this will be my chance to kind of spend at least the beginning part of this talking about things that I've known and learned over the years about trading and about markets. And I think for people, I know there's a lot of people who trade, and they don't think about the macro environment. So normally, like you said, when Liberation Day is happening, it's easy for people to kind of think about, well, this is happening because of this. I don't believe this is rational. Let me go. That's not what's happening right now. So you mentioned a lot of things that are falling. Here's what's not falling. The S&P 500 as of yesterday's close was down 1.5% for the month, and it was still up 14% for the year. Goldman Sachs and JP Morgan made new all-time highs in the last 6 days. That's not a bear market. So I think I'm gonna bring a little bit of insight to people on what happens this time of year, because a lot goes on in October, November, December that I think people that are trading should kind of keep in the back of their mind. Take it out every year when they get into it. And this leads to a personal recommendation, for everyone, especially in Bitcoin, since a lot of the audience is there. We get caught in these emotional moments. And then 6 months later, if Bitcoin's 120,000, everyone forgets them. So these moments happen. They're part of just our lives and they're part of trading. So the way my father always taught me, hey, if the way you're betting's not making sense, then just sit out a couple races. And because he was handicapping horse races, he said, wait until you get things that you really like. So if you think something is off at is off on the board at 20-1 and you think it should be 5-1, that's a good spread. If you think something should be 5-1 and it's 7-1, sit that one out. Like, don't look for a little bit of value, look for big value.
The fat pitches that Buffett would
The fat pitches. That's exactly it. And I don't think the panic at the market level is there, but here's what's happening. We've seen since Oracle. So I want people to go back to the day, because I was actually at a Robinhood event the day that Oracle released earnings and it gapped up 30%. One of the largest moves by a big stock ever. It may have been. It was a 30% gain for a stock that approached that day $1 trillion in market cap. Since that day, it peaked and it's been going down, and now its debt is selling off. CDS for it is going up. So we've hit a new point, and this started with Oracle. Then we had the Fed rate cut in September. And again, a lot of things shifted. And I've talked on here about unwind trades that were happening first at the quant level, but now it's starting to spread. Retail also got hurt. Now, when retail got hurt is when we started to get into October. Gold peaked. But more importantly, these power like Oklo and a lot of these names that have no revenue, they started to get hit hard. And a lot of these names, quantum names, nuclear names, they're down 40 to 60%. And these were big call option names. These were big things. Then you had Palantir come out. So you can see kind of the dominoes that are playing out that lead to a rotation. Now, I wrote a paper this week about CoreWeave. There was a great post by someone, Kai Wu. I don't know if you've ever seen him, but he posted something about how companies that have lots of CapEx, how they typically do. We're at a weird point in the cycle. So the S&P is barely off the all-time highs. We have all these companies that have done a tremendous amount of CapEx. And now with CoreWeave, we actually saw a company that had to cut their CapEx guidance, not for all the bubble reasons, but because we have shortages of physical stuff. And so I believe that we're in a late cycle type trade. Commodities, the Bloomberg Commodity Index made a 3-year high this week. That's not typical in a slow growth period. The market is rotating away from what has worked now for 2 to 3 years. And these are companies that, to me, have made a peak. So growth as a factor has made a peak. And I believe now we're going to be in a period where there are new things that are going to be leadership. The reason I said November is an important time period, October is when mutual fund tax loss selling typically happens. 50% of the S&P 1500, believe it or not, is down for the year. So there was a lot of selling that went on in that caused some of the disruption. Then you get into November, you've got the bank's end of year. And as traders and someone who worked at a bank, you have no upside in November. So you don't take as much risk. That leads to, if people come in to buy call options, you're like, I'm not going to get in a position where I sell too much. So you start widening out your markets. People get trapped. At the same time, buybacks start to slow down because we go in the blackout period and they're really important this time of year. They're starting to kick back in now and they're gradually every week going to get bigger, but you end up with that kind of risk. And then you get into the hedge fund side. If you're someone who's had a good year this year, and I've talked to some of these portfolio managers over the course of the last couple of weeks, they don't want to lose the bonus that they have. And they're paid on a performance. So if they start losing money when the AI trade and the momentum trade unwinds, they're more likely to sell out of things. So when you put all these factors together and then you add in the fact that the people that have lost for the year are getting stopped out, I believe there's a massive rotation that is going to continue to go on. But we've already done enough damage for these names that are down 40 to 60%. Oracle's already gone down enough. We have Oracle's earnings coming out in 2 weeks. We have NVIDIA coming out next week. I think the market will find a way to stabilize. And then once people kind of stop trading and they're like, okay, I'm going to wait until the holidays are over, then the buybacks will start to drift things higher. But I do think for people trading there's going to be new sectors that lead and a new story for next year.
Jordi Visser just broke down the hidden mechanics behind the current market turmoil. While the S&P 500 remains near its highs, a powerful and highly specific rotation is happening under the surface. It's not driven by widespread panic, but by a predictable seasonal confluence of events. Mutual funds conducting tax loss selling, banks de-risking their books, and successful hedge fund managers protecting their year-end bonuses. This coordinated unwinding of the popular growth and momentum trades is the direct cause of the pain in speculative assets. And since Bitcoin is highly correlated, it's caught in the churn. This explains the paradox of why Bitcoin's price is struggling right now. But Jordi argues these seasonal headwinds are just noise, masking a much more profound, multi-year transfer of the asset that is quietly underway. He sees a historic handoff occurring from Bitcoin's earliest bootstrappers to a new class of institutional owners. However, this transition isn't simple or painless. In fact, for this generational transfer to be complete, he believes there's a crucial distribution phase that still needs to play out. He now explains why more short-term weakness might be a necessary and even healthy part of the asset's long-term maturation.
All right. So this is where, so when I wrote the paper about the IPO price, within the paper, I said, it still may go lower in the interim. And the reason is because of what you said at the beginning of the question, which is there needs to still be more distribution from the original people that bootstrapped this asset. It needs to happen. Part of it needs to be opportunity cost. Part of it needs to be diversification. But every single day, the ETF inflows continue. The treasury company buying continues. There's a handoff on things that didn't exist to what does exist. A16Z put out their State of the Crypto report. I'll be going through about 7 to 8 of the slides because I think they get into the point that I'm most interested in. So I'm a macro person. I don't care about, I care what it does each day, But my vision of it is not about what it does this year. It's not even what it does next year. If we're still at 94,000 next year, trust me, the sentiment will be even lower and people will be hysterical. But I believe the volumes are going to increase. The network effects are going to happen. Caitlin Long is a beloved person in the space because of the fight she's shown. She's reiterated her thing, which I agree with too. Money velocity sucks in the traditional finance world. There's so much money trapped with the few that own it. So it's very similar to Bitcoin, meaning highly concentrated. Well, the trad fiat world is highly concentrated and owned as well. Most of the assets around the globe are in the top 1% of people. It's actually to some degree worse in terms of the concentration. And a lot of that money doesn't move. It sits in real estate. Tokenization is going to happen. Stablecoin volumes are going to happen. AI agents are going to happen. Those three things are the holy trinity of the digital economy taking over the traditional finance world. That's not a guess on my part. That is going to happen. We still have 3 years left of this administration. We haven't got the Market Structure Act in. So when clarity is in, for everyone who's doubting where it's going, that's a trader mentality, and that's fine. You have to have that mentality at this point because you got to preserve if you're trading. If you're someone who's thinking about where it's going to be 5 years from now, 10 years from now, like I am, 20 years from now, I fundamentally believe what I've said repeatedly on every podcast I go on. I'm interested in the way artificial intelligence is going to change the world. It is disruptive to the wealthy. It is disruptive to everyone who's had a moat around their lives, who's had a moat around their business. What it's good for is the people transacting. I believe in prediction markets. I believe in tokenization connected to prediction markets. All of these things to me are going to happen, and they're going to continue to increase next year. The one thing that didn't happen this year, as long as Dan Ives is right and the stocks that he's following are doing well, people don't need Bitcoin. They don't need that innovation. What drives people into an innovative name like Tesla or Bitcoin, it has to happen when there's not as many opportunities and choices and things that are working that are bigger market caps. Bitcoin has a market cap where history will tell you when you get to this level, you're real. Like, you don't have to doubt it anymore. Could we go to 80,000? I guess we could if the stock market falls off. But I don't think the S&P is going to fall off. I think we're at the end of a liquidation of growth stocks, and that next year growth will not be a good factor. Growth has a variety of times where it doesn't work. Bitcoin is heavily, heavily correlated to retail trading. It's heavily correlated in the short term to growth. If I'm right and growth isn't going to work the way that it is, this is not a value trade. This is just, if the growth names are not dominating the market, then Bitcoin's going to start to be sexy again when it starts to trade higher. Price drives in the narrative always, as Paul Tudor Jones said. It's something I believe in. The narrative is bad right now because the price is bad. If the price is back up, the narrative will be very good.
We began with Jordi Visser's simple but powerful diagnosis. Bitcoin's narrative is bad right now because its price is bad. What we've learned is that this price action isn't a sign of fundamental failure, but a symptom of a much larger, predictable force at play in the market. The current weakness is a direct result of a seasonal, mechanical rotation. As mutual funds, banks, and hedge funds de-risk for the year-end, they're selling the high-growth speculative assets that have worked all year. Bitcoin, being heavily correlated to this trade, is caught in the downdraft. But beneath this temporary churn, a more profound, multi-year handoff is underway, as the asset slowly transfers from its earliest adopters to a new class of institutional owners. The dynamic Visser lays out is clear. When powerful institutions protect their year-end profits, the momentum trades that carried the market suffer. And so does Bitcoin in the short term. But the inverse is also true. If those dominant growth stocks stop working, then capital will be forced to seek out genuine innovation once more. That is the moment, he argues, when Bitcoin becomes attractive again. This short-term pain, then, is part of a necessary distribution phase. The key condition to watch is the performance of the wider growth factor. As that trade unwinds, the long-term structural demand for a new digital financial system may finally reassert itself. Follow for the next update. We'll track this as it unfolds.